I rise to say a few words about an issue that's been front and center in my office for the past 12 months, reforming regulation of our financial markets. I'm a family farmer, and in my neck of the woods, farmers usually don't sit around and talk about economic policy and Wall Street financial institutions. But I do guarantee you where I come from, everyone talks about common sense and why so much common sense seemed to be missing when America's financial industry almost collapsed a year ago. Everyone in my state felt the impact of what happened when Lehman Brothers caved in, when Fannie and Freddie hit a dead end, when AIG went belly up, when we saw daily headlines about bank mergers and bailouts. We all paid a price because of a few greedy actors on Wall Street and no refs on the playing field. The price was $700 billion of taxpayer money. I opposed that bailout because it rewarded the wrong people, and I was concerned about its ability to create a single job for our small businesses or help one family farmer. I think it was a bad deal for Main Street. Last year, I asked Treasury Secretary Paulson, the former chairman of Goldman Sachs, about why this happened. His answer, and I quote, "I don't know." Where I come from, answers like that aren't good enough, and terms like too big to fail don't make any sense at all. It's time to make some changes. Mr. President, after what we've been through over the past year, it's clear that we need to reform the rules that keep America's financial industry on our side. How? Well, it's going to take a lot of hard work. It's going to take a lot of honesty and a lot of common sense. We've already started. I've teamed up with some of my friends in the Senate from both parties to co-sponsor the TARP Transparency Act. Our bill will better track the money being used to get the financial industry back on its feet, because it's taxpayer money and because taxpayers deserve no less. Over the course of the past year, the Senate Banking Committee has held countless hearings on regulatory modernization. The administration has put forth a good faith effort in working with Congress in the massive legislative overhaul. And government has worked with the financial industry and consumers to outline the goals of sweeping new financial regulatory reform. Now, I don't believe comprehensive financial reform will guarantee that we're safe from financial crisis. But if done right, it can provide folks with adequate protection. It can bring confidence back into the marketplace, and it can minimize the risk of financial meltdown, similar to the one that we barely weathered last fall. Unfortunately, there are those who do not believe comprehensive reform should be on the front burner. They're now lobbying to protect their own self-interest, their own profits, and the status quo over consumer protection. That is why we need to use this one-year anniversary as a reminder of the need to act now to protect consumers and investors, to close the loopholes in our regulatory framework, and to ensure that no company is too big to fail. Mr. President, we must regulate derivatives. We must supervise financial companies that have been outside the scope of regulation, thereby creating a level playing field. We must ensure that there is strong supervision of all financial firms, not just depository institutions. We must build on the bipartisan success of the credit card legislation and pass mortgage reform to protect consumers. We must combine the numerous banking regulators into a more simple, streamlined, common sense structure that is capable of supervising 21st century financial institutions. We must create an entity that will protect taxpayers from future financial corporate failures and minimize the need for further government action. We must increase capital standards to prohibit institutions from growing too big to fail, and we must ensure that those companies selling mortgages and securities keep some skin in the game by holding on to a portion of the underlying asset to keep them honest. As we move forward with regulatory reform, I will be working hard to eliminate any unintended consequences, specifically as it relates to community banks and credit unions. In Montana, when we talk about the banking industry, we're talking about community banks and credit unions. They're the good actors. They don't live on the edge. They didn't get into the Wall Street shenanigans that caused this mess. Montana's community banks and credit unions serve their towns and communities reliably and safely. We are fortunate in Montana to not have had a bank fail in over 10 years. We also have one of the lowest rates of mortgage defaults and foreclosures in the nation. And we've had very few problems as it applies to predatory subprime loans. The community banks and credit unions are not the problem. So I want to make sure that we do not place excessive fees or regulatory burdens on these small but very important institutions like the community banks. Over the course of the coming weeks and months, I plan to work with Senator Dodd, the chairman of the Senate Banking Committee, and all of my colleagues toward common sense reform that will increase supervision and transparency of the financial markets, that will bring back investor confidence, and that will protect consumers and safeguard us from another situation where the greed of Wall Street penalized hardworking families. Earlier this week, the President spoke on Wall Street. He said, "We are beginning to return to normalcy," but he warned that normalcy cannot lead to complacency. I couldn't agree more. And that's what we in Montana call common sense.